This is what it says here in the end. The UK's Financial Conduct Authority has said it expects asset managers to take any necessary or appropriate action to ensure they do not create risks to market integrity or financial instability. So what does that really mean? That they're supposed to lie to keep market integrity? So how can a market have integrity when asset managers or bankers are lying about the prices that they use? Monday, February 13th, 2023, Maneco 64, home of alternative economics and contrarian views. I've got an interesting story for you today, and it's about the FCA. FCA is the financial regulator for the UK. And I thought this was outrageous. It goes to show that the financial system is very fragile, that it's on its last legs, and that if you have a big exposure to it, i.e. if you have financial assets not outside the system, they could be in trouble. So we're going to look at that today. Before I start though, just give you an update on Rudy. He's here with me. He's growing. He's learning very quickly. He's not perfect, of course, but very clever boy. And yes, there he is. The other day he tried to jump on the sofa. Of course, he couldn't make it up there. But yeah, so just a little update on Rudy. He's about 10 weeks old now. I'm going to put him down on the floor and he should be all right on his own. So before we look at the UK regulator, I just wanted to reiterate, and this of course is not financial advice, and actually truthfully buying gold and silver is they're not financial assets, but I think this is very serious, what's going on, and that's why I continue to stack. The other day I made a video at Peter Morris, Coins and Metals. I'm going to put him up in the cards. He's the local coin dealer for where I live, and I've known him for over 20 years. I don't have a partnership with him. I don't benefit if you go there. He's more into numismatics, but he also does have bullion, silver, and gold once in a while. And one of you asked in the comment section, of that video I made about my trip to the coin dealer, what I bought. Well, I've got the list here. He did 2 receipts for me. He just put my name down. He didn't put address or anything. And you can pay cash over there. He accepts cash. So in terms of silver, I bought 30 pre-1964 dimes, and they cost £2.50 each. And I bought 12 quarters, pre-65 quarters, and he charged me, how much did he charge me? Just under £4. It was 48, but he put it down to 45. He gave me a little discount. The other thing I bought I thought was interesting. I haven't started reading it. It's this book here, Coins and Christianity by Kenneth Jacob. He has loads of books there too. So I got this. This was £5. And then I bought also a memorial sovereign, 2022 memorial sovereign. Yes, it has King Charles III, and you might think whatever you want about him, and I'm not too keen on his support of the World Economic Forum, but it's a nice coin nevertheless. I bought that. So I bought a bit of silver and some gold. There you go, that's the coin. There he is on the back. I know some of you are gonna be critical of this, but gold is gold. And as for my other partners, the people I partner with. Of course, there's Gold Investments in the UK. Maybe one day I'll make a video going into Gold Investments. It's different than Peter Morris. Gold Investment is more a bullion dealer. They're in the city of London. They're very close to the Bank of England. And then in the US or North America, I'm partnered with recently with ITM Trading. And ITM Trading will help you if you're not familiar with gold and silver. They'll help you with strategies on how to preserve your wealth, how to even increase your wealth through precious metals, and they will do a free consultation. And the same thing goes for my other partner, Andy Sheckman at Miles Franklin. And one of the reasons I do have these partners is that people have many years ago asking, where can I buy gold and silver? And I always say, do your homework, pick whoever you want. And the people that I use and that I'm partnered with, I think they are reputable. So give them a try. But if you find someone that you prefer, that's up to you. So enough of that now. Let's look at this story that I saw this morning. And I think it's highly significant. And it's in the FT. And the FT, of course, doesn't seem to think it's outrageous, but I do. So we're going to go through the whole thing. I'm going to read the whole article. It's not very long. And the takeaway from this is that you can't trust any of these prices that are out there in the financial markets anymore. You can't trust the data that comes out, let's say from the CFTC on the COT report. Of course, they've delayed that. They're saying that one of their contractors, providers of data, has been hacked. Yeah, so can you trust the CPI data? No. Can you trust what the Fed publishes publicly in its Fed reports, or even anything else, or the New York Fed or the Bank of England? I think we're in the dark, people, and this is a sign that we're near the end of this fiat currency system. So let's go to the story now. It's Insight Investment ditched market prices in gilt crisis. Asset manager chose its own valuations for fraught day preceding Bank of England rescue. Well, this is akin to someone who works in a shop, for example. They keep track of their transactions every day, and they write down for the corporate office, if it's a big company, what they've done. And this is akin to like making things up. So let's go through it. This was published 3 hours ago, so it's fresh off the presses, so to speak. One of the UK pension industry's biggest asset managers abandoned mark-to-market pricing on funds reeling from the country's government bond crisis last year, instead choosing higher values that presented a rosier picture of its position. So FT says abandoned mark-to-market pricing. That's a huge, well, that's a euphemism. I don't think you need to say huge, but basically they lied about the prices when they reported the values of their funds. But let's continue. The highly unusual and previously unreported move by Insight Investment came at the height of the September crisis that began with then Prime Minister Liz Truss' disastrous mini budget. The typically sleepy, liability-driven investment industry, which serves defined benefit pension schemes, was rocked by the sharp fall in UK government bond prices after Truss's government announced unfunded tax cuts. Well, I would say it was not just because of Truss's mini budget. Yields had started going up a few months before. So yeah, they're trying to deflect the attention from the fact that these people lied about the prices and focusing on Liz Truss's government. a crisis quickly engulfed the 1.4 trillion pound sector, which is dominated by Bank of New York Mellon. So Bank of New York Mellon owns Insight Investments. So this is Bank of New York Mellon, BlackRock, and Legal and General Investment Management. Most LDI managers mark down the value of their funds each day in line with plunging gilt prices, since the funds used leverage. The falling values often triggered immediate demands for cash collateral from their banks. The dynamic created a vicious circle in which drops in gilt prices forced LDI managers to sell more gilts to raise cash. But on the day the Bank of England stepped in with a rescue scheme, Insight disregarded market prices and set its own, pushing its funds' asset values per share higher, in some cases markedly. So, and these, we're going to come to how important this is in a second. Insight told the Financial Times this month that its LDI funds operated as normal through the dislocation. Chief Executive Abdallah Naufal told the House of Commons Work and Pensions Committee last year that Insight was never forced sellers of gilts, largely because we used a more conservative buffer. He added that the environment at that time had been tough. Well, they were never forced sellers of gilts because they lied about the gilt prices so that their funds would look better than they were actually were. But Insight's actions on September 28th illustrate how tough it was. By that morning, LDI funds were starting to crack. The Bank of England later described this as a period when market participants were shouting on the phone for help. Insight had just hours left before it reported the value on its funds for September 27th, a typically humdrum daily process that involves scraping data on the previous day's gilt prices and reporting the numbers each afternoon. Marking the funds to market at September 27 rates close to the lowest point in the crisis would have generated a grim result. Instead, for that one day, Insight took another path. Well, they lied about it. Anyway, it says, after the BOE announced its targeted bond buying rescue scheme at 11 a.m. on September 28th, which instantly pushed gilt prices higher, it gathered its 5-person fund board, which comprised 3 independent members and others from BNY and Insight, or Bank of New York Mellon. They decided to mark the books for September 27th higher by disregarding that day's gilt moves and marking to market around prices that had prevailed in the middle of September 26. So you can see here by this chart, it was a significant move from the 26th to the 27th. So yeah, they lied about the prices. They used a price that was not the price for the 27th. Markets were dysfunctional. Well, that's their excuse. This is what Insight is saying and told the FT. In such circumstances, the fund board had discretion to apply a fair value adjustment to market prices. A decision of this nature is made in the best interest of all shareholders in a fund. So I would say as well that the Bank of England kind of helped this lying, really, because it came in and it stepped in to interfere and intervene in this market with, of course, bank money, central bank money created out of thin air to buy these gilts. Let's continue though. Industry experts say the price adjustment may have shielded Insight from having to sell quantities of gilts large enough to destabilize the already brittle gilts market still further, and also prevented it from making demands for cash of its clients. BNY Mellon's chief executive, Robin Vince, told the FT last month he was proud of how Insight had handled the crisis and pleased with how it has drawn in new clients as a result. Well, I wouldn't want to be a client of Insight, seeing that they lie about prices. They make things up. I mean, this is outrageous. I think another reason to get out of the system as much as possible. And that's just my opinion. I don't like to deal with liars. No other LDI manager tweaked its prices, industry experts say, and other gilt market participants say they were still able to find reference gilt prices throughout the crisis. We didn't like the prices, but using them to market was the right thing to do, said one person at another LDI manager. He added that Insight has come out of this crisis smelling of roses, in part because of its decision not to use that day's gilt prices. Simeon Willis, Chief Investment Officer at pensions consultancy XPS Investment, said altering prices was not common practice, and he did not see it as a model for dealing with periods of extreme stress in the future. Publicly, this is the interesting part I told you about. This is how significant it was, this cooking the books by Bank of New York Mellon. Publicly available data shows the impact of Insight's adjustments. In one case, the LDI Solutions Plus partially funded index-linked gilts fund 2061 to 2070, the net asset value per share leapt from 45.57 pence for September 26 to 79.54 the next day. That was at odds with the falls in gilt prices on September 27th, which pushed the yield on the UK's 40-year inflation-linked government bond up some 0.68 percentage points, according to Reuters data. The BOE has described the speed and scale of gilt moves around that time as unprecedented. Yeah, the reason they were unprecedented, Bank of England, is because you've been running totally irresponsible monetary policy for about 15 years of zero rates and massive QE. That's why it was unprecedented. It's coming home to roost, Bank of England. The Central Bank of Ireland, which regulates Insight investment, declined to comment on dealings with individual firms. It had previously advised LDI managers to enhance their resilience, whatever that means. And here's the kicker, why I think you cannot really trust the FCA. And by that I mean, when you see an investment or a company in the financial sector that says they're regulated by the FCA, it might as well mean nothing, to be honest. 1 second. Sorry about Rudy. Anyway, this is what it says here in the end. The UK's Financial Conduct Authority has said it expects asset managers to take any necessary or appropriate action to ensure they do not create risks to market integrity or financial instability. So what does that really mean? That they're supposed to lie to keep market integrity? So how can a market have integrity when asset managers or bankers are lying about the prices that they use? So yeah, they did not condemn Insight Investments or Bank of New York Mellon. So that's why I think things are not what they seem. And when you can't trust the prices of publicly traded funds or even stocks or even data from the government or the central banks, then I think things are in a perilous state, I would say. So this reminds me of a quote by a former Eurocrat called Jean-Claude Juncker, or Juncker. I think he's from Luxembourg, and he said that when it becomes serious, you have to lie. Well, maybe so, Mr. Juncker and Bank of New York Mellon, but eventually lies come out and they're exposed. That's the problem about lying. And shame on the FCA actually for condoning this kind of action and saying that it maintains market integrity, which is totally upside down, of course. So with that, let's quickly look at where the markets are this morning. and does it really matter looking at these prices now that we know what's going on? Well, there's nothing else we can look at, unfortunately. But let's continue then. It's 8:15 a.m. London time. We've got spot gold at 1863, is down about $2. High's been 66, low 56. Spot silver is down 3 cents, just below 22. Low has been 78 and the high 22.04. The Dow futures is down 49 points. The NASDAQ 100 is down 25 and the S&P is down 8. To the currencies, sterling is unchanged, so is the euro, with the exception of the dollar yen, which is a little stronger. Everything seems pretty steady. The dollar is up about 0.2% versus the yen at 132.30. Let's check some of the other currencies here. The Aussie dollar is unchanged. Dollar's up about 0.2 versus the Canadian dollar, 133.63. And the Kiwi dollar is actually up 0.25% at 63.25. Platinum is down $3, trading around $9.45. We've got WTI crude down 1%, trading at 79.05. Brent crude is down 1% as well at 85.36. High-grade copper is up 0.5% at 4.04. Last but not least, let's check the bond markets. The U.S. Treasury 10-year is unchanged at 3.75. Let's check the gilt market. The 2-year yield is up another 4.5 basis points at 3.66. The 10-year is up 6 basis points at 3.46. And the 30-year is approaching 3.9. It's up 6.5 basis points at 3.88. And I think we're continuing we're starting, to see gilt yields creep back up, and we need to keep an eye on it. Could we have another LDI crisis? Probably not, but it could trigger a crisis somewhere else in the system, in another sector of the financial system that we don't know about, another opaque system where, or sector of the system where they're using a lot of derivatives. Derivatives, of course, and the leverage is really what's going to kill the system. And with that, I'm going to wish you all a very good day. Take care. Bye.